For many American families, the credit card is no longer just a payment tool. It has become a bridge between the paycheck and the grocery bill, between the utility payment and the next deposit, between the cost of daily life and the cash available to cover it. That is the quiet pressure behind America's credit card economy. In the first quarter of 2026, U.S. household debt reached $18.8 trillion. Credit card balances stood at $1.25 trillion. Those figures were reported by the Federal Reserve Bank of New York on May 12, 2026. On paper, credit card balances fell by $25 billion during the quarter. At the same time, credit card limits increased by $60 billion. The meaning is important. Even as households carried more than $1 trillion in credit card balances, the system was still expanding the amount of credit available. For an ordinary household, this is not just a financial statistic. It can mean groceries charged now and paid for later, gasoline put on a card and carried into the next month, an electricity bill, a repair bill, or another basic expense covered with credit because there is no easier option at that moment. The credit card economy was not created by one company or one decision. It is a system. Banks issue credit. Consumers borrow. Interest rates determine the cost of carrying a balance. Household expenses determine how often people need the card. And when the cost of living rises faster than the room inside a family budget, credit becomes the pressure valve. The verified data shows how large that pressure valve has become. In 2024, credit card debt exceeded $1.2 trillion. Credit card purchase volume reached $3.6 trillion. Americans were not only carrying large balances, they were also moving an enormous amount of everyday spending through credit cards. The cost of that borrowing was rising as well. According to the Consumer Financial Protection Bureau, consumers were assessed $160 billion in credit card interest charges in 2024. That was up from $105 billion in 2022. The economic meaning is straightforward. When households carry balances, credit cards do not simply delay payment. They can make the same purchase more expensive over time. For regular people, that difference can appear month after month. A grocery bill does not necessarily end at the checkout counter if it remains on a balance. A gas purchase does not necessarily end at the pump if it becomes part of revolving debt. A utility payment does not necessarily end when the bill is paid if interest continues to accumulate after the due date. That is why the average percentage rate matters. In 2024, the average APR was 25.2% for general-purpose cards. For private label cards, it was 31.3%. Those are significant borrowing costs. They change what credit means. A credit card can still be convenient, but when balances are not paid in full, convenience becomes cost. And when basic expenses remain high, that cost can become part of the household budget itself. This pressure did not appear without warning. On February 28, 2025, Federal Reserve researchers examined rising credit card delinquency rates after the pandemic period. They linked much of that rise to expanded credit availability for riskier borrowers and to higher real debt. Delinquency is one of the clearest signals of household stress. A household does not become delinquent because a number on a chart moved. It becomes delinquent when the payment due no longer fits the money available. The research did not say every borrower was in trouble. It did not say the entire system was failing. But it did show that risk was building in a place many households already understand: the monthly credit card bill. The pressure continued into 2026. In April 2026, Federal Reserve data showed revolving consumer credit rising at a 10.4% seasonally adjusted annual rate. Revolving credit is debt that can be carried month to month. Credit cards are a major part of that category. So when revolving credit rises, it suggests that more borrowing pressure may still be moving through household balance sheets. The human meaning is direct. More revolving credit can mean more households using debt to manage expenses that do not stop. Food does not stop. Energy does not stop. Shelter does not stop. Electricity does not stop. In May 2026, the Bureau of Labor Statistics reported continued pressure in consumer prices. The Consumer Price Index rose 4.2% from a year earlier. Food rose 3.1%. Energy rose 23.5%. Gasoline rose 40.5%. Electricity rose 5.9%. Shelter rose 3.4%. These are the categories that shape everyday life. They are not optional for most households. People can delay some purchases. They can avoid certain luxuries. But they still need to eat. They still need to get to work. They still need electricity. They still need a place to live. That is where the credit card economy reaches ordinary Americans. It is not only about shopping. It is about timing. A bill arrives before a paycheck. A repair comes before savings recover. A grocery trip costs more than expected. A tank of gasoline takes a larger share of the budget. And when there is not enough cash available at that moment, the credit card becomes the bridge. But that bridge carries a cost. That cost is interest. The verified numbers show how large that cost has become. From $105 billion in credit card interest charges in 2022 to $160 billion in 2024, the cost of carrying card debt increased sharply. That is money leaving household budgets. Money that cannot go toward savings. Money that cannot go toward rent. Money that cannot go toward car repairs, insurance, or the next emergency. This is why the story is not only about debt, it is about household flexibility. A family with savings can absorb a difficult month. A family without savings may have to borrow through it. And once borrowing becomes part of the routine, the household budget becomes harder to reset. The current situation is clear from the verified data. U.S. household debt is $18.8 trillion. Credit card balances are $1.25 trillion. Revolving credit is still increasing. Credit card limits have also increased, and many basic living costs remain elevated compared with a year earlier. No single statistic describes every household. Some people pay their cards in full. Some use cards for rewards or convenience. Some carry balances only temporarily. But the broader data shows a large and expensive credit system sitting underneath everyday American spending. That is the credit card economy nobody planned for. Credit cards were built to make payment easier, but for many households, they may now be helping hold together a budget under pressure. And that pressure does not come from one place. It comes from food, energy, gasoline, electricity, shelter, interest, and the gap between what life costs and what households can comfortably pay. That gap is where the modern credit card economy lives. It is not always visible from the outside. It can look like a normal card swipe, a minimum payment, a balance carried one more month, a credit limit that rises while the household budget stays tight. The unresolved question is not whether Americans use credit cards. They do. The question is how much of everyday life is now being financed through them, and how long households can continue absorbing high borrowing costs while basic expenses keep pressing on the middle class. For regular people, this is the current situation. The bill still comes due. The balance still carries forward. The interest still adds up. And behind millions of ordinary purchases, A much larger economic system is quietly reaching into the American household.